Hey everyone, and welcome to today's show on Wealth Strategy Secrets. Today we're joined by Andrew Campbell. Andrew is a native Austinite and managing partner at Wildhorn. He is a real estate entrepreneur who first broke into the business in 2008 as a passive investor. In 2010, he transitioned into active investing and management of a personal portfolio that grew to 76 units across Austin and San Antonio. He earned his stripes building and managing his personal portfolio before founding Wildhorn Capital and focusing on larger multifamily buildings. At Wildhorn, Andrew is focused on acquisitions and maintaining investor relations, utilizing his marketing and communications background to build long-term relationships. Andrew's background is in market research and brand strategy, spending over 10 years across acclaimed advertising agencies and emerging technology consultancies. Andrew, welcome to the show.
Thanks for having me. I'm looking forward to the conversation.
Yeah, absolutely. No, it's always great to connect, and being a partner and closely working with you guys over it's been at least 3 years now. It's really been great to see you guys really operating, understand your methodology, how you guys are kind of approaching the market, how you're managing from an asset management perspective. And I think, frankly, that's what's really on everyone's mind today, right? As we're recording this at the end of October, and so much going on in the market, right? I mean, just so many different events and everything. So, I think a lot of investors are, really concerned about assets, right? And trying to understand, are they positioned the right way? But before we kind of jump into some current market dynamics and, your take on that, for the people who aren't familiar with you, can you talk a little bit about, your background and your journey, and, how did you even get into real estate in the beginning?
Yeah, which is a great question. When you read through that bio, it seems it's certainly a winding journey. I was born and raised in Austin, and kind of had the good fortune of we joke, kind of being born on third base and tell people I hit a triple. I mean, Austin has been a incredible market, frankly, my whole life. I'm 42. It's grown tremendously, and grew up here, went to UT, got an advertising degree. In 2007, my dad got really sick, had a stroke, and I was living out of state, came home and kind of helped him. And that was really the trigger, I'd say, that A, got me back home, and B, got me into real estate. And really, to your point about just kind of thinking differently and growing wealth, triggered me, I'd say, in thinking about, I got to do something different. I was on the corporate path. I was working in ad agencies, and I had left that, was been working in tech, but I was on a corporate path, and doing a 401k and doing a little bit of stock investing. And I think when my dad got sick, I just realized I needed to do something different, and I started buying rental properties. I really wanted passive income, and just figuring out, how do I either not work as hard, or have some passive income along the way to supplement, or just free up my time. I think became super important as I was trying to figure out how much help he was going to need, and what kind of life I wanted to have. I didn't have any kids at the time, but just thinking big picture. So that really is what probably shifted it for me, and got me into real estate. And then pretty quickly, and again, a lot of this goes back to being, lucky to be from Austin. I'd buy a property, I'd fix it up a little bit, and it would double in value. I'd pull out the equity, do it again, and spend a few years doing that. And I think along the way, kind of fell in love with it. I mean, the business, and I think just having tangible assets, being able to walk up and see what you're doing, and the investments you've made, and see it bear fruit, materially and financially, but also just seeing the difference you're making in an asset, and frankly, in people's lives, doing a lot of the property management and talking to your residents and your tenants. Like, I kind of just fell in love with that. And that's kind of how Wildhorn started, and how I really said, this is, and sort of my wife's insistence, like, this is what you're clearly passionate about. Go do this like full time, go do it bigger. And yeah, you learn that the bigger properties are more efficient. It's easier to manage 250 units than it is to manage, 4 units. And certainly when you got them spread out across the city like I had, that was the springboard for Wildhorn. And today we've got most probably close to 4,000 units and like 15 assets across Austin and San Antonio. And um, it really comes back to initially wanting something different and thinking a little bit differently about uh, investing and just creating a different type of life.
Yeah, for sure. And was there a particular trigger or something that, moment that you had that really, made you think unconventionally and think that, 401ks weren't the right route and you wanted to get into passive income?
I mean, it was really back to reevaluating my whole life. When I moved back home and was trying to think about what do I do next, and kind of helping my dad. And I've always thought differently, and or at least felt like I wanted to think differently. And maybe some of that was being in sort of a creative industry and advertising, but not being just go along with the flow or kind of challenging convention. So it was maybe some of that in the way I'm wired, and probably led me to invest in real estate in the first place and sort of take that leap. But I think as you get into it, you realize it is different, and it's got all the intrinsic benefits, the tax benefits, it's inflation resistant, it's a hard asset, it's all these things. And I also just got it more. Like there's probably an inherent maybe lack of trust in the man, the system, whatever you want to call it. Like I don't understand how the stocks necessarily work and manipulated, and who's valuing things, but like I get the value of an asset, a piece of property, whether it's a duplex or a 300 unit. You can understand how that works because I can see it. It's not that complicated. You paid X, somebody's paying Y for rent. Yeah, you've got debt in the middle, and you keep it up, and there might be a lot of zeros after it, but it's not a complicated business to kind of wrap my head around.
Yeah. No, that makes perfect sense. And I think most people can relate to that, right? Because even if you're not an investor, you likely have your own primary residence and you kind of get the dynamics, right, of real estate as it is. But let's unpack that a little bit. I think it's really a great point. And so many people, I mean, how many times have you heard, right, people transition from single family into multifamily? But you'd never really heard people say, well, I went from multifamily into single family,
Mm-hmm.
right? So I think there's some really interesting points, and we'll love to, kind of get, your perspective on that in, why choosing a team like, Wildhorn, right? It really puts you in that passive position. But there's so many, you now have this professional team, right? That's finding the asset, number one, that's managing the asset, right, and kind of taking care of it. So can you talk a little bit about your team structure and that as it relates to, let's say an active investor on the single family side?
Yeah, 100%. And it's a great, again, kind of my journey. You realize there's not such thing as a passive investment when you own a rental property. Whether that's a single family, a fourplex, a small apartment. It's nothing about it is passive. And you also, it doesn't support a team. There's not the financial ability to have a management company and an on-site manager. And so you're the maintenance guy. You're getting the phone calls when a toilet backs up. You're doing the financing, and you're the construction. You're all of it. It's not passive. I think as I was falling in love with the business, you realize, okay, it's not going to be passive. And in my sort of whole psyche shift, that I wasn't looking for passive investing. I think I love this stuff. I want to do it forever. This is fun. You see the bigger properties allow you to, even me as a day-to-day, I'm very active in the business, obviously, but each property supports 3, 4, 5, 6, 8 full-time employees that are managing a lot of the day-to-day, the maintenance requests, just keeping the property clean, the leasing. So I think that was part of the appeal of the larger properties. You also get the efficiencies of roofs and systems and parking lots, et cetera. You see the math, how it's broken out. It's not one home or two homes in a duplex that are sharing one roof. It's, there's 10 or 12 units in this building under one roof, and it's one parking lot for 300 units. So all of those efficiencies really add up and make it frankly, a better financial investment from a team standpoint. And as you think about, if you're a passive investor and you're investing with you guys or investing with us on a deal, I think that is truly the only sort of passive type of investment where you're getting sort of trust and giving your dollars to a fiduciary to go manage them. But then we have the teams and systems in place. So Each asset has, again, those on-site team members. There's probably, let's call it 6 on an average, 200 unit building. We've got 6 full-time employees. And on top of that, we've got our Wildhorn team. Today we have 6 employees, or six people here that are all focused on it every day. So we've got asset management, we've got construction management. We are reviewing the business plans, kind of where our debt sits, kind of what's coming up down the pipe there, where our business plan is. Are we getting the renovation premiums we thought? When do we need to order our next batch of materials so that we have the vinyl flooring that we need, or the single basin sinks that we're putting in, and monitoring kind of the premiums that we're getting relative to the comp. So it can get rather detailed, and there's a lot that goes into it, because again, you're managing a big asset with a lot of zeros behind it. But that's kind of the machine we've built that allow us to be in the assets every day and to focus. I think it's also part of the reason, and for us, it's really important. I think for investors, it is why we've stayed focused locally. So we're exclusively in Central Texas, Austin and San Antonio, where I'm from, where the company is, and it gives us the ability to be in our assets. This morning, let's say we've had 3 different people at 4 different assets, but we're in our assets constantly. It also gives us kind of that local market knowledge and conviction about making sure we're on the right corner and we're in the right part of town, and that we understand what's happening. So it all ties into it, just being clearly it's very active for us. But I think as a passive investor, you want that trust in your operating partner, that they are in the business and they're being active, and that they know what they're doing and they're engaged.
Yeah, absolutely. And I think really passive investing goes really to your greatest asset, right? Which is really time, and I think people often underestimate that when they say that, hey, real estate is a great idea, so I want to go get some rental properties and doing that. But once you've had a few smaller properties and you realize, you start getting sucked down the rabbit hole of these small minutia that you get involved in, that's really not how you want to scale and grow, your life, your time, right? And by being able to work with a professional team such as yours, you get access to top-notch professionals. You get access to, these different markets. And that's really, our business model, right, is to work with, operators such as yourself, right, that have a really strong competitive differentiation, a strong niche, maybe based on particular market or particular asset class. So getting exposure to, the Austin market, I mean, it's been such a hot market for so long. It's really a great place to be, for sure.
Absolutely. I think that's a big part of it, and agree. It's been a good place. I think it'll continue to be a good place, but it's home, which helps.
Yeah, for sure. And all of that inside knowledge, like you said, I mean, and it starts with even identifying the deal in the first place, right? Identifying an off-market deal, and you have those deep relationships with the brokers, right, that know that you guys can execute. So identifying the deal in the beginning, and then managing the deal throughout the life cycle. But Andrew, let's transition a little bit into the current environment that we're in. Do you still believe multifamily is a good bet right now? We've got rising interest rates, seemingly unstoppable inflation that's going on. There's major events kind of going on in the world, and we're seeing the markets. It's been definitely a tough year on the stock market side. So do you think, being in multifamily is still a good bet for you, or, what are you guys seeing right now?
Yeah, I mean, we do. And I think it's probably part of the reason that I started the company, just a personal belief that multifamily is the best asset class and the sort of safest investment out there. It's always been, I think, as in the last, call it 5 years, 10 years, whatever, it's been extremely hot, right? And in some ways, we've outperformed every pro forma we've had, and rent growth has gone up and cap rates have compressed, and it's been incredible. But I think the underlying thesis of what we've always believed in, and what I feel, is that multifamily is the safest asset class, and Central Texas layered on top of that is the best geography. So it's it's been somewhat of a defensive investing strategy kind of from the get-go. Particularly, I think as I transitioned and we started raising money from people, what I wanted to make sure is like, I don't want to go lose people's money. I don't want to have those conversations of here's capital calls and not, sorry, this was a risky deal. We've never had that attitude and mindset. I think we're a group that has never taken more than 70% leverage. That's kind of an internal rule we've got, so we're not out there chasing 80% leverage. And look, at some ways that's hurt us from a marketing perspective over the last several years, because people are out averaging or marketing, hey, this is a 20 IRR, or that we think we'll have this huge return. And we've always said, look, we're going to underwrite conservatively and stay kind of in our lane and probably outperform this, but we're trying to hit a low teens, and then we've been lucky to vastly outperform that. I think as the market has shifted and you've seen the volatility in the stock market, interest rates rising, multifamily still to me feels like the safest bet out there. I think talked a lot with other friends and operators and just in different spaces in real estate that some of the other asset classes are almost untouchable. A friend of ours operates in Nashville and was talking about a multifamily deal and said, look, we think this is the downside here, kind of a worst case scenario on this deal is an 8, let's say, if just everything falls apart. And on office, the downside is 0. If you buy an office building and you lose your tenancy and the economy's in the skids, like that's not a place you can be. I think, at least for me as an operator, saying, hey, what's the downside risk? So as much as things have shifted and pricing is off from its peak and interest rates are rising, we're still seeing people pay their rent. We're still seeing rents are still growing. This goes back to being in a shelter business, in an uncertain environment, that it's not the most sexy, and it hasn't offered 5x returns like some private equity things or startups have. But I think in an environment like this, it may be the most important time to be in a good inflation resistant kind of asset like Central Texas and high growth market like Central Texas, and multifamily is a good place. So that's kind of been my view.
Yeah, sure. Can you break that down just a little bit more in terms of, what does safe really mean to you? Right. So you just talked about the market, but let's drill into that a little bit more.
So I think safe at the highest level, it's like preservation of capital. Do I believe that my personal investment, that if you're investing with us, your investment is safe, and that there's little to no risk of that going away? Or if you give me $1, we're going to give you back something less than $1. And I think if we look at where we sit today and kind of how we've always underwritten deals, our break-even occupancy, to service the debt, has always been 78% on average. So if our building's 78% occupied for a sustained period of time, like a year, we can still service our debt and move forward, right? And you look at 2008, 2009, which was a real estate bubble and just a bad time for the industry. The average occupancy in Austin and San Antonio was like 88 or 89%, and that lasted for about 3 or 4 months. So if you look at that sort of safety blanket, if you will, of how much occupancy would have to drop for us not to be able to service our debt, that to me is safety from an investing standpoint. Now, in that environment, are we going to hit the underwritten returns? Are we going to hit a double digit, a mid-teens return if we had to go sell a building? No. But will we be in an environment that you're losing your principal? That's unlikely either. It's hard to fathom. Whereas, stock market, you could lose 50% of your value in overnight, or some other asset class where the volatility is much higher. There's more certainty baked in, I think, is the way we think about it.
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com.
Right. And you wouldn't be forced to sell. So let's say that, the market conditions aren't really right, even though your pro forma had you selling on, in a 5-year type hold, there would be nothing forcing you to sell, would it?
No, and obviously it depends on your loan structure, and kind of the duration and your term. One of the things that, again, staying conservative on leverage is something we've always focused on, and then making sure we've got duration. So if we've underwritten a 5-year business plan, we're modeling a 5-year exit. I think where you will see some potential pain is folks that have gotten really highly levered and have said, hey, to hit this pro forma, we're going to refi it in 18 months, so we're going to get in and out of this thing, and counting on the fact you're going to get some qualify for an extension on your loan, or there's going to be new debt available. We're fortunate to not be in that position. We've got things that are maturing over the next year and beyond, but kind of depending where they are in their plan. I'll give you an example. We've got an asset in San Antonio coming up on 5 years of ownership. We had a 10-year fixed rate loan, so we have no gun to our head. Ideally we'd exit this year or next year, but we're not forced to. And that's a huge piece of it. And again, as an operator, as the principal of a company, not losing sleep at night that hey, we're sitting behind a really bad position here. We've got a metric debt coming due and no way to refinance it, and we're going to have to go sell. Like that's the way you get hurt. Again, I don't think you're losing people's money there, but you're not in control of your destiny, if you will, as far from a timing standpoint.
Right. And given the current debt markets, what type of structures are you favoring right now on the buy side?
Yeah, it's interesting. I mean, today we don't have anything that we're under contract on, looking to go execute now. Obviously, the market is slowed down a lot. I think you're seeing, if per our previous comment, if you don't have to go sell, there's no reason to sell right now. Prices are down. A lot of groups are just sitting on the sidelines. It's getting to the end of the year. There's just so much volatility. People are waiting for a little bit of direction, or maybe signaling from the Fed that, hey, we've gotten as high as we need to and we can stabilize some. So there's not a ton out there. And as we're looking at it, I think what you've seen, so rates are up, significantly, probably tripled in some cases from where they were beginning of the year. You're seeing the total dollars they're putting out be much low. So your leverage point, it was, say we're at 65 to 70%, or I mean, previously you could have been 75 to 80. You're at 55, 60% leverage, maybe 65, but that's going to be almost 7.5%, 8% interest rate. So it's hurting the values of some deals and what people can pay, strictly based on the financing and kind of how much negative leverage you'll take from a cap rate standpoint and what people can pay. And the lenders it's just a fundamentally different market than it was certainly 6 months ago, but even 45 days ago, as the forward curve of SOFRs continue to blow out and it's eroding the values on deals. I think, to specifically answer your question, we would probably lean more towards a floating rate execution right now. Again, a longer term, put a rate cap on it, but believe that over the next 5 years, rates will, tough to see them going a whole lot higher, and betting that they come down some, but certainly not looking to get a really fast 2 or 3 year term and hope that happens in the immediate term.
Yeah, makes sense. And as you kind of look into 2023 right now, given current conditions, really from the acquisition side, what are you guys really forecasting? What's your plan for next year?
We've got a term we use called consistent attendance, and that's meaning we want to always be out there active, looking at what's out there, talking to brokers, talking to their owners, operators, just being consistent in our sort of conversations and our methodology. So we've never had a target from a acquisition standpoint, whether that's deals or dollars or units. We want the ability, when we find something we believe in, and we use the word conviction a lot. When we have conviction on something, we want to be able to execute it. So that's always been kind of our mindset, and I think that won't differ next year. I do anticipate first half of the year deal volume maybe picking up a little bit from where it was this fourth quarter, The folks that, again, if you've got a debt maturation coming up, they'll sort of be net market sellers, and those deals will be out there. I think in Austin, in kind of San Antonio specifically, some of the new construction, the stuff that's coming out of lease up, those developers will still be sellers. They're ahead of their pro forma. So you'll see a lot of kind of lease up new construction deals that are trading. But we are really focused on being resourceful, and I think looking at lots of different types of deals, looking for ways where whether it's ground up construction, partnering with a developer we know, and kind of being the operator of that. If it's a redevelopment play, if it's a value add, being selective but opportunistic, and just seeing what's out there. But we think it'll be probably a little bit slower, at least first half of the year, as kind of the world waits for this to settle out a bit and have some direction on, is it as bad as everybody thinks it could be? Or are we kind of at the top from an interest rate perspective? Just things need to settle down a little bit, feels like.
Right. And what do you think in terms of the market that you're in right now? Do you foresee any material changes really happening in your market, or what are some of the latest updates?
From what standpoint? Kind of just performance of the properties, or
yeah, I mean, from job growth, population growth, rent growth. What are you seeing, and how do you anticipate that changing right over the next 12 months?
Yeah, so population and job growth, I think we see those both continuing to grow. It's interesting where our kind of article this month talks a lot about that, and sort of our involvement civically with a lot of the real estate council of Austin. And Cooper will be the chair of next year, and just the data suggests continued population growth. The Chamber of Commerce Austin's got a pipeline that's probably never looked so full, sort of in their words, that it's what's attracted companies here over the last decade. It continues to attract companies here, and the economic volatility, coming out of COVID and now sort of in this new higher interest rate world, and things are shifting, probably only accelerates and continues to sort of prop Austin up more so than some of the other markets. So we think that the job and the population growth will continue next year, and frankly for a while. One of the reasons we've got so much conviction about staying local is nothing that has happened here has fundamentally changed, and all the sort of tailwinds are behind us. So that front, we feel good, and those are the two most important factors, by the way, for us, just from an investment thesis. It's population growth and job growth. And this goes back to being in the shelter business and not being in office, not being in retail. Some of the things, like, people need to live somewhere, and they're moving here in droves. The affordability piece has really had an impact. That's probably the biggest thing, the biggest challenge we've got as we've grown so fast. That Austin is quickly, the cost of living is quickly increasing. You layer in higher interest rates, and the property tax values up. I think I saw a stat last week. It's $900 was the average increase in sort of a mortgage if you had versus a year ago, and in some places a lot more than that. So if you weren't buying a home, previous to this run up in Austin, it's tough to do that now. It's tough to qualify, which buoys the performance of our assets. Again, that may not be a great thing long term, but in the sort of mid to short term, we'll stay full. And you look at sort of the development landscape in Austin, it's always been challenging. It's not just we just approve everything. It takes 18 to 24 months to get your entitlements and get your plan in place. So there's a lot of supply coming. And as you look at just the population growth that's coming, it sort of supports it. But we think that rent growth, it has to slow down, and we've certainly modeled that back in our underwriting, or throttled that back. But we've been 20% for the last year plus. So we say it's slowing down, and we're seeing it sort of in real time sort of start to moderate some. Like, that was inevitable. And I'm not sure how much of that is economically driven versus just people can't sustain, nor should we expect them to sustain 20% year over year rent growth. But property performance is good. It maintains, it's strong. Occupancies are strong. Renewals continue to be good. So we think all that, it may fall more in line with historical averages. I think next year is still going to be, higher than a 3% average rent growth, but it's cooling off from sort of where we were.
Yeah. Yeah, I think a lot of people don't realize, back in 2008, right, the default rate overall for multifamily was actually less than 1%, right? And it really just
Yep.
supports those macro dynamics and the things that, you were talking about of basically, investing in real assets, right? And also having a long-term view of this. Some people, I think we all get sometimes a little conditioned from, Wall Street and the markets, right? That, things are, like you say, you could lose 50% of your value, overnight. Real estate is slow and steady, right? And you have to, be a long-term, visionary, right? To see your investment kind of play out and make decisions based on the long term. And that's how you win at the game. But, I would concur with you that, given all the analysts, a lot of the top, investment firms and things where people are positioning their money right now is in hard assets, right? And where the fundamentals, again, you have primary main imbalances in supply demand. There is still a huge shortage of, supply in this country. And then when you go into this, hyper local market, right, of San Antonio and Austin, right, there's even less supply, right? So I think that insulates us a little bit further. So definitely agree with your thoughts on that.
Yeah. It's something else and I'd love your opinion on this, because I feel like it doesn't always get, I'll say, the credit it deserves, or maybe as much thought. But if you're comparing investing in the stock market versus a real estate investment, and you're looking at kind of what your return is, and what's the average return in the stock market historically is 9%, and you're looking at a real estate return of, let's say it's 9%, but factoring in, and how do you think through some of the other benefits of some of the tax benefits, the depreciation, some of the inflationary aspects of being, sort of benefiting, if you will, from some of the inflation. I've not seen a formula that can take that piece into effect, but do you think through those pieces when you're making kind of personal investments, and how do you quantify that, if at all? Because it's something we talk a lot about. I certainly personally am thinking about it, but it's 9% is not always just apples to apples when you add in some of the other true, tangible benefits you're getting as a one investment over another.
Yeah, Andrew, that is really the basis of our holistic wealth strategy, right? And the book that I wrote that kind of encompasses that. Because again, I think you're absolutely right. As people look at things basically single threaded, and they just want to know what is the return on investment. But when you start looking at things comprehensively, right, through a lens that takes you 360 degrees, right, you realize that we're going to get into these assets and get some tax efficiency. Okay, so that's going to offset the passive income, the passive gains, right, that are coming, out of this, your investment here. You do have the income, the predictable income, right, that you're building as well, and you're getting paid that on a regular basis. And then on the back end, right, you have a chance for some lucrative, upside potential, right, when you exit the property and we can sell and hit that equity multiple target, and then really transition those funds right into the next opportunity and defer your taxes even from there, right? So I think I really see this as really a trifecta or a three-dimensional type of investment. And we have models that, I've been running years, even personally, when I got into this, and I'm looking at the IRR, right? So when you calculate the IRR and you put into it, things like bonus depreciation, right, and what you're actually getting out of that, it's really substantial. And we even have a calculator on taking a 401k and saying, how is your 401k performing over a 15-year period versus what if I actually sold my 401k, paid the 10% penalty, paid all the taxes up front? When is your break even analysis, and where would you be, in 5, 10, 15 years? And it's quite compelling that, if you have a good property, right, such as, some of the deals you guys have done, and you just rinse and repeat, right, you can actually break even, 3, 4 years pretty quickly, and, really accelerate your money. But in addition to all of that, there's this other component, right? Which is, we're thinking about a rate of return really from like a multiple, multiplying your money perspective, right? But this is also about protection of capital, right? So on an asymmetric basis, not only are you getting better returns than the market will give you, but you're doing that on a risk adjusted basis. So that's really powerful. And then there's this other unseen benefit that I think, again, is super, powerful and underrated. It's all about having control. So again, to your point earlier, you wake up in the morning and you see that your market positions are down 50%, down 20%, and, for no rhyme or reason, right? Something completely outside of your control. Whereas, as you articulated earlier, when you're in multifamily, right, you have a business that you understand all of the market dynamics, right? It's much more long-term, and you can control the levers, right, in terms of how you manage it. And then investors get the choice to say, hey, I'd like to get some exposure to a market like Austin. So I think having control and then creating these alternative passive income streams, really come in and all further mitigate your risk, right? Because if you lose your job or something like that, it's nice to know that, hey, I can pay my mortgage, right? Because I have multiple income streams coming in. So that's a little bit, you got me fired up right there, because that's really our investment thesis, Andrew, and how we see things, and multifamily fits in there quite well.
Yeah, it makes sense, and that it's interesting. I'll have to get that calculator you talk about, the kind of how you add all the benefits together, because it's hard to quantify. They exist, and it helps me sleep at night, but it's not always apples to apples.
Yeah, for sure. So Andrew, if you could give investors just one piece of advice on how they could accelerate their wealth journeys, what would it be?
I think not be afraid to think differently, which a lot of what you and I've kind of talked about today. Just trying something new, whether that's investing in a rental property or a piece of real estate, or talking to a friend about a different strategy, just doing something alternative. I think the more you do that, the more your eyes get opened to different ways of thinking, different return profiles, types of deals, and it kind of puts you down the rabbit hole a bit of all the different things that are out there. So I think just starting to think differently, or even sprinkle some capital into a deal that somebody or trust is talking about, to experience something that's not just throw money at a 401k and blindly see what happens. Something where you have a little bit more control, a little bit more touch and feel from an operator or whoever it is that's putting it together. Just trying it, because I think I've found that I really liked it. I mean, I have the vast majority of everything I do is sort of alternative and relationship based, and it's not just let's just plug it into a stock market wheel and see what happens.
Yeah, great advice. I mean, you really have to take action. If you're someone that's out there on the sidelines, kind of listening to all these podcasts and trying to learn and everything, it is easy to get paralysis by analysis, and the best way to learn is by actually doing a deal, working with a trusted partner, like Andrew's team, and really, seeing for yourself the results. And, we got to work with his team during the pandemic, right, and how they handled that. So I come from the Marine Corps, and we talk a lot about people who were, battle tested, right? And you really see what people's real colors are when the bullets start flying. And you guys handled that, extremely well during that time. And I think, it really put investors at ease, and that's great. That's how you want to be positioned, right? Because this is a team sport. Investing is a team sport, so working with quality teams like you guys is really helpful. So appreciate the words of wisdom, Andrew. Appreciate your time and what you guys are doing. If folks would like to learn more about yourself or Wildhorn, what's the best place to reach out?
Well, appreciate your time as well, and enjoyed the conversation. For us, we're pretty easy to find. I mean, our company is Wildhorn Capital. Our website is wildhorncap.com. My email is andrew@wildhorncap.com, and we've got kind of social media feeds, and try to post some interesting, relevant content. But the website's probably the easiest, best place to connect directly, and you can enter your email there, and I'll follow up with you, or you can email me directly, and I'll follow up with you.
Awesome. Thanks again, Andrew.
Thanks for having me.
You bet.